All right, good afternoon, everyone. Welcome to today's webinar. Today we have James Saunders, Jessica Logan, and Jen Riggsby joining us from USI. James is a national practice leader in the property and casualty space. Jessica is a New England practice leader, and Jan is a personal risk specialist. Jan works with clients at Milestone, and she's in the office here in Bedford. USI, if you have never heard of them, they're a national insurance brokerage, and one of their many arms deals with individual property and liability insurance, which is what we're talking about today. They also happen to have their regional office upstairs from us in Bedford, so we have a good relationship with the team up there, and they graciously offered to talk to us and you today about the current state of property and casualty insurance in the United States. A lot of topics today, ranging from how to reduce risk and premiums, cyber insurance, umbrella coverage, risks happening across the country. So some really great content, excited to get into it. And if you have any questions throughout the webinar today, just put them in the chat and we will, or the question box, and we will get those answered as we go through the webinar. And with that, I'll turn it over to James, Jessica, and Jan. Thank you guys for being willing to talk to our clients today. Really appreciate it.
Thank you so much, John. We appreciate being here and happy to speak with you. Um, John has kind of talked about this already, but just for today, our agenda, we're looking at that current state of personal insurance and then ways you can really take control of your risk and help both in savings and making sure that you stay insurable in the future. And then, of course, we want to prioritize your asset protection and talk about flood insurance, things that not everybody thinks about, but we want to make sure you know it's out there and what's available. Throughout, like John said, we are open to questions and we'll make sure and leave time at the end as well to get through as many as we can. So with that, I'm going to let James kick it off.
Yeah, thank you, Jan. Thank you, John, for having us. Before I dive into this, a couple things, I guess. First, I'll say, although I'm not in New Hampshire now, I am a New Hampshireite from Amherst, New Hampshire. I went to high school there, so just down the road from your office in Bedford, and a proud graduate of the University of New Hampshire in Durham. So I'm not so proud of their hockey program the last few years, but certainly still a proud cat. So, as we go through this, a couple things, we're going to inform you about what's driving the insurance market. But what I would hope for everybody is to start understanding or thinking about it as you taking control of it, just knowing the levers you can pull and decide where your risk tolerance is for yourself, for out of pocket, for potential uncapped losses, and then making decisions. But understand kind of the mechanisms that are driving the costs of insurance, right? So I'm going to walk through some of that here. So then the first place to start is the reinsurance. So every insurance company you buy your car insurance, your home insurance, or any other insurance from actually goes to another insurance company and buys insurance to cap their potential losses, typically from large catastrophic events. So depending on where you are, so for example, if you're in the seacoast of New Hampshire, your insurance is going to be more because part of that is a passed through expense that the insurer you're working with is paying to another insurance company, a reinsurer, to kind of protect themselves on the back end if a large storm comes up the seacoast and damages a bunch of properties, right? So several years ago, that market in particular had a significant capital challenge, and so we saw the market retreat, and so there was less capacity in the market. So simple supply and demand. There wasn't enough reinsurance out there. So those that were still in the game were charging more to provide the insurance, which then that cost was just simply taken and grabbed and passed through to the consumer in the form of rate increases over time, right? And so it takes a couple of years for that stuff to flow through the system. But what we are actually seeing is the last couple of reinsurance renewal cycles have seen more capital come into the market. It's stabilized prices. The increase is kind of normalized, if you will, to give the analogy of inflation, right? We're not disinflating, we're just inflating at a normal rate, but we've seen all those really large steps up over the last few years. But you'll see as more capital comes in, more insurance companies will have more appetite and capacity. And if that continues, hopefully we'll actually see people actually start in a competitive market, right? Competition breeds better pricing for the consumer. We're not seeing that generally yet. We're seeing little signs of it in different markets. One in particular would be in Florida. We're seeing more insurance companies coming back where there's a lot of hurricane issues, right, and concerns. We're seeing it more locally on the Cape. We're seeing more insurance companies come in and willing to offer terms. And while I haven't specifically seen anything in New Hampshire myself, I'm sure on the seacoast in particular of New Hampshire, we're also seeing an opening up of appetite, which again will breed the competition, which is what you want. When you only have one or two people playing in a certain spot, they can kind of charge whatever they want to provide you insurance. As you get to 5 or 6, all of a sudden they have to worry about what the other people are offering. So but it is a big driver in our insurance marketplace is the reinsurance cost. And the good news is, 2020 they lost that market lost something like $70 billion as investors pulled money off the table. As interest rates have come down, right, and investors start looking for better rates of return, that we're seeing capital flow back into the market. So hopefully that trend continues. And if you want to go to the next slide, Jan, or actually we can pause there. I know we want to try to pause periodically in case any questions come in, John.
We don't have any here. What was the big spike in 2023?
So 2023 is actually where we saw a return on the equity. So those couple of years there where they weren't making money. And what we saw in 23, 24, and 25 is they've priced well and reshaped how they insure stuff, so they're making money again. So that's what they're seeing is it's not that the storms stop happening. It's not that wildfires stop happening. In the reinsurance market, they'll typically attach at a certain size loss. They've now stepped that way up. Right. So for them, they make more money because there's less actual events that trigger them paying out to make it as simple as I can. So through contracts, what they're charging and attachment points, they're making more money, which that's part of the reason we see more capital flowing into the market because people are like, well, what about me? Right. Similar to you would see in investment markets, right, is the same kind of track of if there's a return on capital, more capital flows in because everybody would like to make the return. As there's no return on capital, you see outflow of capital, which actually, right, reduces people's ability to make returns. So
the return on equity is better if it's above the cost for them at least.
Yeah.
Okay.
Correct.
Gotcha. Right. Thank you.
Yeah, and interest rates affect it, right? Because if the risk-free return keeps going up with buying treasuries, then you need that much more on putting your capital into an insurance marketplace for your return, right? So when it was zero, there was a lot of capital looking for risk, right? You look at it from an investment market standpoint. As those interest rates went up, that pulled back. Sure. Right. And we had a massive fires, hurricanes, all kinds of losses. So that brings us to the next slide, Jan, if you want to jump in there. So good or bad, right? We had many billion-dollar events in 2025, starting with, part of LA burning, right? But all in all, compared to prior years, it was actually not a bad year for insurance. We were all thinking probably in February, this is going to be a rough year. And, our clients are going to see more rate increases or insurance companies non-renewing policies, all that sort of stuff. But actually coming out of that, hurricanes season was relatively uneventful, and other winter storm events were not particularly bad at the end of the year, all that sort of stuff. So overall was a fairly good performing year for insurance companies and their reinsurers. So the good news is that contributes to the stability I just talked about. I guess it's not. I guess it is bad news. Is we're kind of sitting in a fulcrum point here. You could have several large wildfires in California or out west, and I think since this is mostly people in New England, we all saw the weird paradigm where like the mountains in the Northeast had 300 inches of snow base, and the mountains out west had like 40, which is usually the other way around, right?
Mhm.
So that unfortunately leads to later this year as that snow or lack of it doesn't melt, right? And one, create water reserves, but two, a lot more dry and dead vegetation in the mountains and uncared for lands that can lead to wildfire risk. So there's a potential that between that and you get a couple of hurricanes that hit in the Gulf and on Florida, and all of a sudden this year has a big, I'm not saying it's going to, but if we did have a significant, billions and billions of dollars losses that then flow through to the insurance, we could be back here talking about how bad things are like we were in 22, right? And so hopefully we don't. Hopefully some lessons were learned. I don't think they all were. Some of it, because the issue was not just the weather, fires, or other things. Some of it is also adjusting our expectations of insurance as a catastrophic protection, not a maintenance protection, as well as regulatory environment being more willing to understand the financials that insurance companies are dealing with and not being as restrictive in their regulations. So, but that said, if that stuff doesn't happen, we could continue to see this kind of stabilization and maybe even potentially a softening in the market.
Do events that happen in other parts of the country where you have property, for instance, you don't see anything in Florida or New England here. Are the events that happen outside of those areas getting priced into premiums in like New England, for instance? Does Florida or Los Angeles wildfires, are they affecting premiums in New England, or is it a state by state basis?
It's regulated state by state, but for a company, yes, I mean to some extent that does occur. It's probably more so just in general the impact it has in the reinsurance market across the board, right? Which whether it's a home in Goffstown, New Hampshire, or a home in Malibu, California, the insurance companies have some shape or form of reinsurance. And if the reinsurance market is going up, that price is passed through, not as drastically, right? Like in New Hampshire, you might see a 20% rate increase on a $2,000 premium, right? That's no one wants to pay an extra $400. But you go out to California and we've had clients that have gone from spending $10,000 on their home insurance to the only offer they could get was $500,000, right? So it's not spread like peanut butter, but it is a intertwined ecosystem. So you do see impact outside of the state borders for sure.
Okay. And 500,000 in premium or in
Yes.
coverage?
Yes, in premium.
How expensive was the house?
That one was like 15 million. So
Okay.
that was at the peak of the hard market, where the problem with wildfire is it's really hard to model and understand like hurricanes, they're really good at modeling it, right? And so they can kind of say, hey, your home is here, and given storm paths and water temperatures and winds and all this sort of stuff and other features of your home, we can actually model what our most likely risk is. Wildfire, not so much. They're getting better at it, but certainly like 3 years ago, they didn't know what was going to happen, right? And so they had some pretty primitive modeling, and if they call it a brush score, and if you had a certain score, they just would say no. we're not going to do it. And then you'd go to the insurance companies kind of last resort, and they would say, I don't know, 15 million. If a fire comes through, I'm out of pocket $15 million, right? So I'll take a $500,000.
Yeah. Well, I guess that's a decision you make when you own a home of that value.
Yeah. Well, and look, someone can say, I don't want to insure this. That's okay, but don't just say I don't want to insure this and walk away. Protect the asset. It's an asset, right? So there are, one of the big things we believe here is like that we believe in risk management. One tool in risk management is insurance and transfer of risk. There are many other tools, right? So you take a home that's on the coast, even in New Hampshire, what is the roofing material, what's its wind rating resistance, right? How is the rafters secured to the frame of the home? So if there is a strong windstorm that comes through, what's that going to do, right? What have you done from, whether it be generators, water shutoff systems, all that sort of stuff to protect the asset? Because if you do all those things, one, the insurance itself might become more affordable, but two, even if you're not, you're reducing the risk of the home, right? So out in California, there's whole home sprinkler systems, not inside but outside, that they have infrared sensors, and they get triggered at 500 yards out, and it sprays a fire retardant and water all over the home structure and the grounds around it. Those are not inexpensive. Those themselves are $500,000. But if someone doesn't want to pay $500,000 a year, they buy that once and they're done, and they say, you know what, God's are I'm not going to have a wildfire burn down my house. So it's one of those things that, yeah, like that's a subjective decision at that point. But our job is to present that information to the client.
Yeah. That's an interesting map. A lot of the events are clustered in the middle of the country.
Yeah. 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 They do this every year. So you'll periodically see these and they move around. But yeah, the bigger driver these days, not individually big losses, but aggregate, are these convective storms in the middle of the country with hail, lightning, and wind, just going through and damaging large numbers of homes in a given state or geographic area.
Yeah, not huge claim amounts, but
Right.
when it's spread
Not,
across a lot of
not a
people.
$10 million house burnt to the ground, but $100,000 roof, right? But times how many, right? So that's one thing. So the good news, I guess, is that 25 continued a trend of lighter and easier years. But we're still in this precarious area where a couple of bad events could swing us back the other direction. And then the last thing I'll talk about here is jump over where you are, Jan. This is just a trending of the home insurance premium. So again, you can kind of see that it's going from 24 into 25. We saw a moderation. So 21 5.9, 21 to 22. Then it went up into the double digits, and now we're seeing it come back to single digits. And we continue to see that. Now that's a national average, right, put together. So individual geographies, even individual geographies within a state or a specific insurance company that has a profitability issue versus another in a given area will dictate where, like, your individual rate, you might say, well, mine went up 5, which is better than 8, or you might say mine went up 20, which is worse than 8. And yes, it is. But there are a lot of factors that go into it. But as an average, you can kind of see that hopefully we continue to moderate the growth.
Yeah, I mean, this sort of tracks with what we saw, especially during COVID, for whatever reason. During that time period, we started to see the increases more than usual. It seemed like it used to be inflation based, but at that point, people started to question the premium increases.
Yeah, no, it's the reality is it's running ahead of inflation. I think we've certainly had numbers of inflation reports where auto and home insurance are highlighted as running ahead of kind of the general inflation trend, and that continues to be an issue. Hopefully, will moderate. It's a slow process because the majority of people have insurance. that is in what we call the admitted market, which is regulated by each state regulator for rate and coverage. So if an insurance company is like, hey, we lost a lot of money this year, we need to increase our rates, they have to go through an arduous bureaucratic process. So the rate is 6 to 12 to 18 months after they've started asking for it. And that's on the good end. Sometimes it's years. And the regulators, they may say, we need to get a 10% increase in order to get back to profitability. And the regulator might tell them, well, you get 5. So now they got to do it twice, right? And by then they need them more, right? So you see, unfortunately, that's where I said the regulatory component of our business sometimes can make this process worse. But nonetheless, I mean, they're there to protect the consumer. So they certainly do a lot of good work on that side of it too. But it does create a challenge for the insurance business. But you should see it, unless something, big spikes of issues come back in, you should see it moderate now that bump of filings has worked its way through.
Well, 8.5% is still pretty high, but hopefully
Yeah, no,
it's closer to inflation.
yeah, we're trying, right? And look, there's tricks and tactics people can do, and we'll talk about some of those to control the cost. But like I said, the first thing is everybody should take a step back and say, where's my comfort level with risk in a general sense, similar to looking at, say, the investments world. And by that is, where am I comfortable being able to write a check out of my own pocket? And then what is my priority to prevent from happening, right? Is it, I don't want my house gone, or is it, my car, I don't want anything to happen to that, or is it, I'm okay if the car is damaged or lost, but I don't want to get sued for $10 million, right? Like, nobody wants any of those, but I mean, kind of a thought exercise around where your comfort level is, so you can start taking control of it instead of just sitting there and saying, oh, I guess I got to write a bigger check this year.
Yeah, I think you're alluding to deductibles and how much risk you're willing to retain, which I think we'll talk about a little bit later.
Yeah.
The auto premiums, did they experience a similar path?
Yeah, they're on a similar
Sure.
track. In a given state, they may be ahead or behind, but generally speaking, that's two things, right? We put all these safety features in cars that haven't prevented accidents. They've kept people alive, which is the good news. The bad news is they've greatly increased the cost to actually repair the vehicle, right? So it's a bumper 25 years ago was a bumper. Now it's got sensors and cameras and all this other stuff, and it's integrated into the quarter panel of the car and all this sort of stuff. So when you have a bumper issue, it's not just, oh, go buy a bumper for $800 and put it in. It's a several $1,000 system that then has to be installed, and the sensors need to be tweaked. If anybody's gone through one of that, they know exactly what I'm talking about. It's not simple, which drives up the cost. And then the other factor, which we can talk more about, is the liability component. Autos are the biggest driver of personal liability, and we're seeing, I don't have to tell. I'm sure everybody around here drives down the road and sees billboards with attorneys, and so there's a big money in suing, and that drives up settlement costs.
How much since you brought up the sensors, how much of those sort of tools and technology that cars have now, has that contributed to people being more distracted or have a false sense of security when they're driving and not worrying too much about people in front of them or behind them?
I don't have it's a good question, John. I don't have an objective answer on that. I subjectively, I think there's probably something to that with a big TV screen sized monitor in the middle of your car. I can't imagine people not being distracted. Where that relates to versus, hey, it breaks for you if something's in front of you and you're not paying attention, or swerves you out of the lane. Like, does the good offset the bad? I don't.
Yeah.
I don't. There may not be enough data on that yet. I haven't seen anything, but certainly what I can tell you is, windshields are $4,000 now instead of $800, and bumpers are $5,000 instead of $1,000, and that's part of the cost increase.
Maybe you can touch on this later, but about when you should and shouldn't put in a claim. Like when the dollar amount isn't worth the future premium increases that you might get from submitting a claim or something. Like you mentioned a windshield. That's sort of like the lowest. Well, you said it was 4 grand. That shocked me, but do, does just you get a crack in the windshield, you have the insurance, so you're like, oh, I might as well replace it. But does that screw you later on because now all of a sudden you have a claim history and everything goes up across the board in the future? I don't know the answer to that, but maybe you guys can touch on that at some
Well,
point today.
yeah, well, we can touch. I don't know if Jan, you were going to cover that in some of the stuff you were talking about, so I don't want to
Not
steal
not
your.
specifically, but overall in trying to keep those claims off of your policy, it really is part of that education piece we do, and just each individual situation needing to make a determination of what makes the most sense for you. In the past, we'd look at a, towing claim or a chip repair and say it doesn't matter. And now frequency of claim matters and does determine whether or not it remains insurable in the future. You remain insurable. So it's definitely something to consider. Whether or not there's a specific dollar amount really is what works for each individual. And we will talk about deductibles coming up here, but trying to find that balance of this is something I can afford to pay out of pocket and should, and knowing that if I choose to file this claim, the next claim may be bigger, but I might need to avoid filing that one because now my claim count is getting high.
That's interesting you mentioned that, Jan, the towing thing, because it's like you have a lot of people have AAA, but you also have this towing thing on your insurance where you're supposed to be able to depend on using that if you get into a situation where you need to be towed. And a lot of people, myself included, don't know that that is actually a claim, which makes no sense to me. But is that true?
That it's a claim, yes, it does file on there. And, a lot of times, if it's a one time thing, you're not going to see a direct impact from that. But when they look and they see, well, every year or even every 6 months, this policy has a towing claim put in, it is an impact of whether or not a new insurance company wants to offer coverage on that.
And I think,
So go ahead.
no, sorry, Jan. I didn't mean to interrupt you. I thought you were finishing.
No, go ahead, Jessica.
I was just going to say, John, I think that's when it's really important to have the right advisor, right? Where they're kind of monitoring those things and saying, okay, this is, your third glass, this would be your third glass claim. Really, the recommendation is to pay this out of pocket, not to impact your future cost or insurability.
And when you say advisor, should people be calling their insurance agent before putting in claims and
Yes.
directly through the insurance company?
Yes, absolutely. To talk through the impact of what that's going to mean for you going forward, as far as rate, as far as, if there's a potential chance to be non-renewed. And like we said, if we're starting to see a trend of frequency of the claims filing, then the agent can help talk you through that and what makes sense for you.
Okay. I can imagine no one's going to call you when they're stuck on the side of the road. So maybe AAA is a better option
Yeah.
than.
Yeah, I was just going to say specific to that, John. What I'm doing personally is I have a AAA membership. If it's not like a super urgent or I'm not in some weird place, I may even opt to just pay it out of pocket for a tow, like if I'm around town. But certainly AAA, it's just not having that small item that you get penalized for. Whether we can all sit here and say that's wrong, they shouldn't do that. And I kind of agree with your sentiment. If they're charging you for it, then don't pay for it and pick it up somewhere else where you're not going to be penalized, like a AAA, because that's what they're for. They're not going to say, "Oh, you've used us, so you can't use us anymore." That's where, like, looking at it from that perspective and saving it for the cat. And to Jan's point, then it becomes a subjective thing. I personally, we had a water backup, and my house is the garage is underneath. We had a water backup that caused problem with the drywall in the ceiling garage. I could have called in a claim, and I don't know, maybe after the deductible ended up with $5,000 or $7,000, I opted not to because I just didn't want to have that claim on the books. I'd rather save it for a different day. That's me. I have a different risk tolerance than somebody else who might say, look, if I'm going to get a check for $1,000, I'm going to put a claim in. But and to Jessica's point, our job is to just make sure, okay, that's fine. Here's how the system works. So just understand if you do that, the next one may be the thing that then triggers them saying, well, we're not going to renew your insurance next time, right? And then you're going to go to the insurance market with a bad insurance score because you have loss history, right? So again, well, I'm not going to go anywhere. I'm going to stay with them, or I'm never going to do it again. Okay, that's fine. There's no right or wrong answer. It's a subjective decision at that point, but made with all the information as opposed to in a vacuum.
Good. Yeah. Thank you. Because I don't think a lot of people really know that.
Yeah.
And that's a great consideration.
One more thing. If your house is on fire, call the fire department first. Then you can call especially if it's a weekend, call like the insurance company because they'll get adjusters and reclamation people out there. That's like a slam dunk. I need a claim. You don't need to walk through it. But if it's stuff like, we have some bumper damage or there was some water damage in the house and I think we can, fix it, right? Those are the ones where you want to have that conversation and the ones that are on the margins,
Yeah.
in the gray area.
A branch fell on the roof.
Yeah, right. Yeah, if there's a tree that came through your house, you can call, and it's Saturday, call the insurance company. They'll start adjusting it. And we would tell you to do that anyways.
All right. We got off on a little tangent there. Sorry about that.
No, that's actually
it's better that way.
exactly. It's great. And it feeds right into, we were talking about deductibles, which one of the ways you can take control of your risk. So just puts us right in the right mindset here. So the top image on this screen is a screenshot from our proprietary tool we use called Navigator. And it's helping understand your risk tolerance. So this is an example on an auto situation. We would go through the same thing on a home situation if we're having that discussion. And it's looking at what your current premium is, what we can estimate, and this is using just general numbers, not your specific policy, but what we could estimate a savings by changing that deductible. And if that makes sense for one, you to save on the premium. Two, if, again, that subjectivity, is that something you're comfortable with? Is it easier to write $1,000 check? Or would you be able to come up with $2,000 if there's a claim? And then three, really understanding and leading into that conversation that we've just been having about not wanting to file those smaller claims. And if you're not going to file the smaller claim, maybe you save that money, set it aside, and you save from having a higher deductible. So being able to apply that in different ways.
Do you guys have thresholds for you shouldn't have a deductible below this amount because it doesn't make sense to put a claim in for something under this amount?
Not a specific threshold, but definitely conversations we have. We used to see a lot of the 100 and 250 deductibles, even 500. We do usually start at $1,000 on auto, and home, depending on where you're at, 1,000, 2,500 or higher. But it's at least letting people, again, have the education piece there to determine what's going to make most sense for them.
What's the maximum deductible amounts that you can have on a auto or homeowners policy?
Really varies by company. So we were talking earlier about how admitted carriers have those rates that need to be filed. So they need to have specified what they're willing to offer. We've seen some autos will go, 2,000, 2,500. Those are pretty common. Others will go up to a $5,000 or a $10,000 deductible. On the home side, when we're talking about insuring those multi-million-dollar homes, we can do $50,000 or $100,000 deductible. It's really, again, determining what makes the most sense for you And if you're not going to file those smaller claims and you know you can cover that dollar amount, then let's make this truly a large loss type coverage.
Because that can really help with the reducing the premium.
It can. And that's, again, where we do those quotes and let you see, it's a dollar amount change. And if you're saving $500 and you're going to pay another $50,000 out of pocket, how many years is that going to take versus, hey, this might save a couple $1,000 and you could earn that savings back or earn that deductible difference back in the savings pretty quickly.
Yeah, well, it's nice that you have that on here where it says what the break even is. But I think there's also the consideration based on what you said before of not the hidden cost of putting in a claim at a lower dollar value that would increase premiums in the future, which makes the break even a little bit shorter if you were to put in a claim. So that's great.
Right. So the second image on there is looking at a couple different paths of insurance. So normally your most auto and home policies these days are indemnity insurance. So following that lower path, you've purchased a policy, now you have a claim. Just like we're doing now, you're having a conversation if it makes sense to file that claim. You submit it to the insurance company looks and confirms that there is coverage, then has to assess the damage, then makes payout. And there's multiple steps, in that process. Parametric insurance is newer, not brand new. It's been around for a few years, but newer to the insurance field. And it's really setting those parameters up front. So we talked earlier about wildfire out west, hurricane and wind here on the East Coast, that those have led to some homes being uninsurable or being insured for everything excluding wildfire or excluding wind. Parametric insurance gives you an opportunity to buy back that coverage, or even to buy down a high deductible that's in there. And what it does is, again, sets those parameters up front. So you're purchasing a policy that, let's talk about a hurricane, that if at your address, wind speeds were calculated at or above X miles per hour and sustained for at least X number of minutes, then coverage applies. If it's a lower mile per hour or not long enough duration, then there is no coverage. So it's a very specific insurance situation there.
Well, this kind of blows my mind because it's almost like gambling almost. It's like Polymarket, that gambling site, like an event-based, you're making a bet on an event happening.
Yeah.
It's specifically to your benefit. So it's not, you can't bet on your neighbor's house getting damaged. It does have to be for your own, you have to sustain the loss, of course.
So is this like, how do you determine what you should be insuring against? Like, what type of events should you be insuring against? Hurricane, you said hurricane, is flood part of this, or is flood not parametric?
Flood in its own way is part of parametric insurance because it is a one specific type of loss at a specific location. So the first thing would be to insure it under your homeowner's policy. So before we look at parametric, it would be looking at, can we cover this loss within another policy? So if your policy covers wind, if your policy covers fire, including wildfire, this isn't a concern. But if you're purchasing that home in California or that home on an island, and insurance companies are saying, we'll cover everything except, this may be your only option. And you have to decide if it makes sense to self-insure or cover it through a policy like this. It's not necessarily going to be a cheap option. It's not, you want to take wind coverage off your home and purchase it under parametric. It's going to be more expensive. But it is an option when you don't have other options.
And what do you like taking New England as an example? What type of policies are you seeing in this market for parametric insurance?
Again, things, if we're seeing a policy that does not have wind coverage or we can't get wind coverage somewhere on the Cape, Nantucket, Martha's Vineyard, if no company is offering that, that's when we would start looking through the parametric insurance option.
You also
Yeah.
see it in that area where, on the Cape Islands where they may, their risk tolerance may be higher. So as Jan said, it may not make sense for them. They may want to self-insure that wind portion, right? So they've decided just to go with the all other perils type of policy to insure that risk.
And the only thing I'd add in is generally you're not insuring like the full value, like a traditional
Right.
policy. You're like, oh, this is the replacement cost of the home, this is the contents. This is I select a limit that I would like this amount of money, and it's usually something less than the total kind of aggregate value of everything. And they do have it for flood. I've seen the ones where they put so this would apply in New England where there's like essentially a device on the property, and if the water hits a certain height, whether it damages your home or not, it triggers a payout, right? So and for wildfire they have it out west where if a certain amount of damage is done, which damage could be, hey, on the corner of my property these number of trees were burnt to the ground, which added together equate to $10,000 of damage, a check is paid. The house itself is fine, right? And then of course the wind is a typical mechanism where as long as within this certain kind of radius there were winds exceeding this speed, there's a payout. But it's generally like if it's a $2 million house, you're not and $1 million of stuff in the house, you're not insuring 3 million. You're maybe getting $1 million payout or $500,000.
What's a ball like if Cape in the Islands or Martha's Vineyard for $500,000 of coverage for the wind hurricane type insurance? What's like a ballpark premium? Do you have? I don't want to put you on the spot, but
That's
is
kind
it
of
like
hard to
20
say.
grand or
It could be. It depends on the flood zone. It depends
yeah,
on the construction of the home, the year built of the home, the entire profile of the account. That's kind of a tough question to answer.
okay.
Subjective.
Do you have a lot of people using this type of insurance, Jan and Jessica in New England?
Yeah, I mean, it depends on the profile, right? So we do, but it's like Jan said earlier, everyone's risk tolerance is different, so it just really depends on the client and their profile.
Okay. And we did get a question from the crowd here. Is parametric coverage is based solely on the event, not damage, which you said yes,
Correct.
right?
Yes.
So if event eclipses whatever the threshold is, or
Payout. Yep.
it
No
pays out the
burden of
amount.
proof. Yeah. No burden of proof of damage. It's some easily measurable, wind speed, water level, you know, fire proximity, something that is just easily and so the part of the reason they can do it is because then there's no claim cost to them other than the check they write, right? There's no adjusters necessarily. They don't have to go out and look at it. They don't have to rebuild it. They don't have to do any of the other soft costs that go into a claim. They just cut a check because the wind blew.
All right, well, that's a very interesting topic.
Yeah.
Why do they call it parametric?
I assume based on those parameters that are set up
Parameters?
front.
Okay.
Yeah.
All right.
Next, really want to touch on ways that you as an insurance client can take control of, one, your risk of trying to avoid that claim, and two, helping where you can with the premium. So we've got several different devices here to talk about. The most common non-weather claims that you're going to have are fire and water. Fire tends to have the higher payout. Water tends to happen more frequently. So these first two are addressing those big ones. In the top left corner, we have a Ting device, Ting. This is monitoring electrical currents in the home to watch for those electrical fires. It plugs into an outlet, you download an app on your phone, and it's constantly monitoring for arcing. If there's unusual surges coming through, even letting you know if there's power outages, that if you're not home, you know that this is going on. It's the only device of its type that I'm aware of. You can purchase it at tingfire.com, and it's $99 for the first year, $49 after that, and that includes the monitoring. So I'll give you just an example. We had this installed about 2 weeks, and I got a phone call from Ting asking me to check something because they were getting these unusual surges they'd been watching for about 24 hours. And they had me move the device from one side of the home to the other, watched it for a little bit longer, it was still doing it. So they determined that it was coming into the home and asked me to contact my electric provider, who came out the next day and had to replace a part at the box where it hit the home because it was on their side. Ting's concern was that those repeated surges were weakening my appliances and could cause something to short out and lead to a fire. So it was a nice benefit within a couple of weeks of having it. The next one along the top there is an automatic water shutoff device. So this is one provided by Flow by Moen. There's many brands out there that do this. You have a licensed plumber install this right on the main line where your water comes into the home. And again, it's going to learn, take a couple weeks, learn the patterns of the home, see what's going on. But if it starts to sense something unusual, it's going to send you a notification to your phone, let you know that, you should look into this. If you don't respond, you're in a movie, you're not checking your phone, whatever it is, it's going to shut down the water. And it's going to err on that side versus letting water continue to run in the home that could be a burst pipe, an overflowing appliance, whatever. These do give discounts with many of our carriers. So, if you get that installed, it's worth asking and letting your insurance agent know to see if there's a discount there for you.
Yeah, Jan, just to when I attended your presentation a few months ago, I went and installed both of these. The Moan was $600, I think, and then like another $350 to have installed. So, it's not a minimal initial investment, but I did get 13% of my homeowners and premium reduced going forward. So, there's like a 10-year payback on it, but just the peace of mind of having that and knowing that it will prevent, hopefully, any water events in the house. And an added benefit is when my teenage daughter stays in the shower too long, I can just automatically shut it off from my phone. I don't have to go down into the basement. So another.
Exactly. And the device did it. It's not even your fault.
No. No. So yeah, I highly recommend these two. Ting is minimal outlay of cash, and it's a cool app to have. Like you said, it shows power outages even if you're not home. So if you're traveling, sometimes it's nice to know if you lose power, and if there's nobody there to tell you, this thing will do that for you.
Exactly. The one in the bottom left is one of many different telematics devices or usage-based insurance on auto coverage. You'll hear it with different name brands like Snapshot with Progressive and Teledrive with Travelers. Most carriers now are giving this option. And what it is monitoring characteristics about your driving so that your rate can be more fine-tuned to your specific driving habits. What it's doing through that app is monitoring things like mileage driven, hard brakes, fast acceleration, handheld phone usage. So if you're not hooked up to the car and using, the proper features there, that handheld phone usage is going to cause a lower score. It gives you feedback so you can make adjustments to your driving and really strive for the best rate that you can. And most companies give a discount up front because you participated. And then at your renewals, we'll set the rate based on your specific feedback.
And my understanding, I use this for Plymouth Rock, and it's an easy app. You can just put it on in the background, and um, I feel like I'm a pretty good driver, so my score seems to be pretty high. But my understanding is like this isn't going to hurt you because a lot of people are hesitant to get one of these because they think it's going to increase their premium. But my understanding is that really you're only being able to save here. You can't
It
really
does,
have your
it does depend on the carrier. Some carriers,
okay.
there can be, for that small percentage that are not good drivers, could see it increase. Again, my best recommendation for somebody that's doing it is to use the app to get that feedback. I know when I did it, I was not starting braking early enough. You're coming up to a light, you see that it's turning yellow, start braking a little bit sooner because it's measuring the amount, the feet per, or miles per minute, miles per hour per feet that you're slowing down. So by giving yourself more time to brake, you can increase that score. So it's really a great way to correct some of those driving habits that maybe we've had for years too.
What kind of
Oh,
discount do you see? I'm sure it differs per carrier, but is it like 5%, 10%?
Up front, they usually give that 5 to 10%. At renewal, we've had companies that will do 30, 40, even 50%.
Oh,
So,
geez.
there are opportunities there to really help control your rate.
yeah,
James, did you
if
want
you
to
have
add?
good drivers, yeah, if you have good drivers in the house, the credit can be meaningful. If you don't, then the 5 or 10% is probably not worth the information they'll have about your bad drivers in the house. Another option is Life 360. If you're just interested in driving data on people in the household, that's not necessarily tied to um, an insurance premium. Life 360 is a good one. John, yeah, I have teenage girls that like to take long showers as well in my house, but also they're driving, or at least one of them is, and so Life 360 is good. One, so as a paranoid parent, we can watch them drive like all of 1 mile every step of the way, but also it gives you a report. They sped up, they hard braking, distracted driving if they touch the phone in the course of the drive, right? All that sort of stuff. It doesn't feed into the insurance or a discount, but it's just from like building good driving habits. It does help with and give you the opportunity to coach younger drivers in the household.
Do any of the apps have that ability to look at the driving habits of the other people that are using it within your household? Like the insurance apps that you have to download?
I believe a couple of them do, like that they have kind of a household manager that has the capability of seeing those. But otherwise, I'm not sure if they all do, because I know some want each individual cell phone number to send the app directly, that each is installed individually there.
Okay. We do have a few questions here about this, and I think you've
Okay.
answered all of them. So, but I'll just go through them. One, does it report speeding and increased costs of coverage?
Speeding, what most of them do is a top speed. So I know, like in the one I was using, anytime you hit 80 miles per hour, it would put a ding on the telematic. Um, I was living in Colorado at the time, so when you're coming off a pass and you're staying with traffic, you go over 80 more than you think. So there was several dings when I looked at that. But that's usually what it is. It's not truly like a GPS that's saying, well, the speed limit here is 35 and you are going 37, it's usually putting a max speed that they don't want to see.
Okay. Next question. Can you use the device without reporting it to the insurance company? I think that would be the Life 360 that
So
Yeah,
James.
Life 360. There's some other. You may be able to
yeah,
get the back end software that the insurance companies use separately. That doesn't.
yeah.
I would say the Life 360, in my own personal research, seems to be the best one. So I just use that.
And if you are a Pure Insurance member, they are currently giving out free Life 360 memberships to eligible members with teen drivers.
Oh, okay. So that was the next question. Can I use it with my teenage daughter, new driver? So yes.
Yes,
Yes.
Okay.
exactly.
I do. Just be prepared for anxiety.
Going back to the Ting and the Moan, do any insurance companies give these out for free?
Yes, some do. Ting, I know Nationwide does, and I believe Pure does as well. The others will have some carriers that can give discounts or have options to purchase, through a discounted rate. But I don't know about any that do a free automatic water shutoff.
Yeah. Okay. Well, those are more expensive and the
Yeah.
installation and everything. So that makes sense.
And like our insurance partners, we've partnered with Moen, but also with a company called Beagle that both do water shut off. Moen is only the Moen device. So kind of the what you were saying, John, it's like for my house, it's $1,000. They come out, they install it, right? Beagle is more bespoke in that they'll go out to your house and assess which device is the best, and they usually have 3 to 5 devices in the truck, and they can handle. The big driver is the water supply line. If it's a typical one, then flow by Moen is perfectly good. If you have a larger home with a larger supply line, you may need to go with a different device, which adds to the cost. But both of those are really good services that we would recommend.
Okay. Great.
And then the last image here is just taking into account cyber protection. So just like all of this, the best step is to avoid a claim when possible, and having some sort of monitoring in place for your identity monitoring, your security at home, using everything you can to avoid any type of loss. So having your credit locked, getting notifications of unusual card charges, setting up a strong Wi-Fi at home, making sure you've got multi-factor authentication enabled wherever you can, taking all of those steps and having some sort of identity monitoring in place is, a huge step. We see with AI technology, what used to be a target of businesses or people, of higher net worth has now been able to be just mass marketed and sent to everyone and anyone. So getting these recorded phone calls that are no longer just an individual dialing nonstop from a call center in a foreign country, it really has broadened who is at risk.
And you're going to touch on cyber coverage later on, which is really exciting new coverage that individuals can get.
Yep, exactly. We're going right into that. Unless there's any other questions here.
No.
So as John mentioned, we do offer cyber protection. There's some limited coverage that you can purchase through an endorsement on your home. But what we really look at and want to offer is a NetGuard cyber policy that is broader in what it can cover, including things like social engineering, where you've had this bad actor that is watching your every move, following your email, and really setting up a whole situation that gets you to release your bank account information. You may be corresponding with someone by email, you think you're still dealing with them, and this bad actor stepped in and said, okay, we're ready for payment. Here's the link. Go ahead and transfer that 100,000 we talked about. And now you're sending that 100,000 to who knows, somebody at the wrong account. So this cyber fraud is just such a concern. So it is a great option to have. And one policy covers the whole family. With NetGuard, it also includes IDX monitoring, so that security monitoring we were talking about, it's providing a lot of that, your password protection, VPNs when you're on Wi-Fi, and all of that. So one of the products we really think highly of.
Yeah, so this covers, as you mentioned, anything that like identity theft, which is like a basic, everybody understands identity theft. It's also your computer gets hacked, they steal your data on the computer and tell you have to pay a ransom to get it back. That's part of it.
Mhm.
Getting scammed into giving money away, whether that be through going, like you mentioned, a false link to make a payment. Does it also cover like granddad went down to the bank because somebody was convincing him he had to take a cash withdrawal to pay off, you know, uh, like lawyer's fees for his granddaughter um, or an IRS lien or whatever the scam of the day is?
James, I know we were kind
Yes.
of talking about
Yeah.
that.
Yeah. We're talking. So yeah, yes, as long as like the initial mechanism was, through, somebody came and knocked on the door, right, and did it. This obviously cyber covers is not going to cover that because there's no cyber in it. The NetGuard policy includes stuff that's done either through the internet, so email essentially, or through telephonic instruction. So, like you see a lot of these, like IT service related outreaches that are, oh, hey, I'm calling from Apple Security, or you'll get an email that says, call us now at Apple Security. Don't do anything with your computer. And they get you on the phone and then get you to download something. Or, like you said, John, they get you to go get, hey, we need payment and gift cards. Or so can you go to the Amazon website and buy $500 gift cards and send them to this email address, something like that. All those sort of things would be covered and included. It's so the fraud in the cyber in that guard policy is truly one of the broadest ones that's out there. That is um, just as fraud implies, right? It's where you are fooled into moving your money because someone committed a fraudulent scheme through the internet, email, or through telephone, usually some combination of all of those to get you to move those funds.
Okay, that's great. What about like the girlfriend on some media site
So
where they're like pretending to be somebody who they're not, and they convince you to send them money from your IRA because they need, help,
so
whatever the reason
if,
is.
if you are scammed in a way to voluntarily part with your funds, and it's shown to be a scam through the internet or through the web, right? Whether it's through a social media platform or email, that is inclusive of that, right? So it's a pretty robust offering, and but I think the bigger thing about it is not just the reimbursement of funds, but it's the coverage of the soft costs, the back end of cleaning out viruses, putting stuff back to the way it was. If it's an extortion event, negotiating with a criminal over a ransomware, all those sort of things. I know crypto's a little more commonplace than it was 10 years ago, but most people still don't have crypto, and that's usually the form of payment they're looking for. So instead of trying to figure out how to go get crypto, they have a consultant that has that in the bank, and they deal with it and resolve the issue.
And what are we talking about for premiums for these policies, and how much coverage can you get?
So 4 different levels of coverage on the NetGuard policy: 100,000, 250,000, 500,000, and $1 million. The first two we're looking at 500 and 625 plus the policy fee and taxes. The second and third one, don't have the numbers right offhand, but I believe it's like 1,600 and maybe 2,500.
Yeah, you're in the
Yeah.
ballpark. Yep.
So that's relatively cheap for the amount of coverage. Are there any exclusions, like if somebody has dementia and is more apt to fall victim to one of these cyber crimes? Is that a issue?
I'm
No.
not aware of that. No.
No,
And again, go ahead.
not anything like related to like a health related issue. There's stuff in there where, you know, there are exclusions like all insurance contracts, but it's not going to catch somebody just because, oh, you're older, more likely to be a victim. So therefore we've put language in that we won't pay out. It'll be, you know, it'll be more like a good example is like we paid out on this claim last time and you went and clicked on the same exact link and sent the same person the same number of gift cards. Like those sort of things will be the issue.
Okay. And you also mentioned there's bullying protection on that. What does that mean?
Yeah, so cyberbullying, unfortunately, is something we need to be concerned about in this day and age. And this provides coverage if your child's that victim of cyberbullying and now they maybe have therapy costs involved. Maybe they're no longer attending school or taking a break. So you've got home tutors or having to take other approaches to their education. It's helping with those fees and additional costs that are triggered from that event.
Just children?
For the cyberbullying, yes.
Okay.
I don't know if there's a specific age on it, but that is, we can look into the policy language more specifically on that.
Okay. We did have a question from the audience for this coverage we're talking about. If your identity is stolen, how do they help you recover it?
So they have built in, like, the way to think about it is there's cyber crime, right? And within cyber crime is identity theft. And typically for any one of our clients or any one of us who has an actual cyber crime event, it's also an identity theft event. Your data has been stolen. Well, all of our data is out there, right? You could go spend about $300 on the dark web and buy anyone on this call's address, social security numbers, everything else you would need to go out and say, open a line of credit, right? So it's out there. So they have a coverage for that, similar to any other identity theft coverage. What they're going to come in is have the response costs, right? So one, that's why when you have an event, this is good because then it'll trigger the clause for identity theft. So you're going to start having the response for that. It's going to trigger, say, the ransom event team first, who's going to respond and negotiate and pay the ransom out, get your data back. It's going to trigger then also the data security team, who's going to come in and screen through your computer system and software and find where the compromises are, root it out, and then rebuild the security around it. And then additionally, it has a bricking coverage in it. So if the actual device is shot, right, if they've put a virus on your computer that turned it into a brick, you'll have a payout to replace that item up to $10,000. I think the limit is. So it's more comprehensive, but the the identity theft is a component of it, and it's the same thing. So I've identified this. Okay, costs to notify credit bureaus, counseling on how to manage the whole process, any additional services associated with a identity theft event. Those costs are picked up through the insurance. And then if there's an actual cyber event, whether it's ransom, theft, or fraud tied to that, then the other sections of the policies would respond for that.
Okay. And that complements whatever the monitoring services that you get for free,
Yeah.
which is hopefully preventing any identity theft
Yeah.
from happening.
Yeah.
Okay.
And the setup for that, I've done, not just a member of the hair club, right? I'm president too, or if I'm not the president, I'm a member, whatever the ad used to be, right? It took me about 40 minutes to click the link once I signed up and went in and I set up the accounts that you want to monitor and the emails and the social media accounts. It'll do everything from as much as you want to monitor and put in there to the stuff if you don't. You get a credit report with it. Um, you can put in different household members to monitor for their social media. It does a dark web scan for your names and information. It does a lot of different things. It's really helpful. It's certainly a benefit. It does take 45 minutes to set it up on the front end, but once it's up and going, it's pretty good. And then you get an app on your phone and you can kind of go to a dashboard and monitor and see what's going
Oh, nice. Another question. So it covers the actual loss from when a client is convinced to give up their user credentials for their bank account.
on. Yep.
Okay. And
So yeah,
then,
that's the difference from a lot of the endorsements and other things. They cover you the soft costs, but it's kind of like the bank ATM theory. Like if you go to your ATM and then walk out and get mugged, the bank's going to tell you, well, you took the money out of your ATM machine. That's not our fault, right? That's how a lot of quote unquote cyber policies work. This one will actually cover you for the fraud event. So you'll be reimbursed or made whole for any funds you don't receive from, say, a credit card or anybody else that would be able to refund you any lost items.
okay. And when you're talking about endorsements, that's like added coverage onto the homeowners, which isn't
Yeah.
as comprehensive as the standalone policy you're referring to. Okay.
Yes.
All right. Next question. What is the cost of coverage? Jan, you already said that. We'll send it out, that flyer that you provided that has all the breakdown of the coverage limits with the costs
Perfect.
to everyone that attended today.
Very good.
All right. We're running a little bit over time, but everybody's still engaged here. So you want
The
to
next,
talk liabilities here?
auto liability, we've talked about this, previously about the fact that cars are more expensive these days to repair. But what this chart's showing really puts kind of a graph to it. The first few years, you can see the average settlement stayed about the same. We weren't seeing large jumps. But as we get, closer to modern years, we are seeing those large increases. Medical expenses, car repair, all of that has gone up. It's also triggering these large jury settlements or nuclear judgments that we'll have, where instead of reaching a settlement with the insurance carrier, that attorney has decided to go in front of a jury because they feel they can get a better settlement that way, has really led to these larger claims. And so when we're looking at it, these are the conversations we're having with clients to try and help them determine the best liability limit for their situation. Again, referring back to our navigator, one of the topics of interest that we go through is helping to make a recommendation there, at least of a range, knowing kind of where your current net worth is, what your annual income is to project future earnings, and using that to make recommendations of where you might be best off on that protection. It's hard for anyone to ever say, how much exact coverage you need. It's obviously you want more than what you're going to be sued for, but knowing what you're going to be sued for is difficult.
Yeah, it's a couple of comments I'd throw in there too, Jan, is a factor that's contributing to the issue is private or third-party funding of personal injury attorneys. So private equity is everywhere. Some say they're ruining the world, but one of the things they're doing is funding personal injury attorneys. So to Jan's point of there's less risk for an attorney to take a case further into the process, generally leading to higher payouts because they're being funded, right? Generally, they operate on contingent. So if the less confident they are in the case, the more likely they are to take an early settlement, a lower payout. But if someone is putting in a floor payment to them, they'll take it further down the road. And so that is part of the ballooning cost, is that third-party funding of these settlements. That's why you're not crazy when you feel like there's more billboards and ads. They're out there because they're being paid for by private equity to drive more business. The second part of it is this concept of social inflation, where if you do go to trial and there is a jury, there is definitely an underlying current of, if somebody has means of any sort, they should be made to pay up. And so that generally actually leads to like a punitive nature of the payments, as opposed to tied to a reality of damages. So that also is driving those costs. So I've personally seen auto-related liability claims where someone wasn't even really injured. They were basically, a vehicle ran over someone's toe. It was a very nice, expensive vehicle. That's why it became such a big issue. But they didn't break a toe or anything. It was not actually major damage. It ended up being a $2 million payout because they just had an attorney that was going to continue to push it. And the insurance company was finally like, you know what, we're just going to cut our losses here and here, 2 million, walk away. I've seen other ones in the mid-teens for millions for auto related. Those are generally not necessarily, it's almost worse to have someone survive an accident but be disabled for a long period of their life. So generally it's usually the person who's the plaintiff who's bringing the case is younger, but they're now injured and disabled, and they have a life of lost income and nursing costs and all that sort of stuff. And so that suddenly goes into the 10, 12, even $15 million range. Now
That's
those,
incredible.
yeah, right. It's kind of scary. Now the middle of the curve is somewhere between 2 and 15, right? So then again, it becomes, to Jan's point, we use our tool and a discussion to figure out, where's your risk tolerance? What do you think's at risk? What are you willing to absorb? Or, how much do you want to make sure that you've kind of cut off the potential loss compared to the cost of the insurance? And that becomes a subjective decision for an individual based on themselves, their risk tolerance, and frankly, some of their lifestyle, right? If your kids are out of the house, you're both older, maybe retired, you're not prone to driving fast or doing things, and you're kind of low key, you're less worried about it than if you've got teenage drivers in the house, or you yourself are an avid driver and like to drive fast and do things, and you have a high profile because you own a business or you are involved in community activities or on nonprofit boards and all this sort of stuff. So if someone were to Google you, or their attorney Googled you, your name would be in lots of places, and then suddenly you're a bigger target. So it's kind of a mix that we look at and say, all right, your risk level of being a target is here on the meter, and what you have at risk is this big, or it's really big. And then you make a subjective, kind of informed but subjective decision on that.
So we have Morgan and Morgan to blame for
Yes,
the increase in claims.
they're all.
All right.
One
That's
last slide, if we have time
depressing,
for.
Jan.
Oh, yeah, sorry.
I hope you're ending on a positive note, because this last graph here was depressing.
Right. So this one.
Oh no, you're not. Flood insurance.
But this one has more potential, right, for coverage. And when we're talking about lawsuits, unfortunately, it is a unlimited. We don't know where that upper limit is. When we're talking about property damage, there is a finite number. How much in general it's going to cost to replace these items. It's a dollar amount. But if it's not covered, that's still a dollar amount coming out of your pocket. So flood insurance is something that you purchase separately. Flood itself is excluded from a home policy. And let's start by really understanding what is flood. So I know when we have a broken pipe, people will say, well, my basement flooded, but that's not the situation we're talking about. This is ground or surface water that's entering the home that is affecting, in most policies require it affects 2 or more adjacent properties or 2 or more acres of normally dry land. And now it's creeped into the home and caused damage. So without coverage under the home, your option is to purchase a separate flood policy. It's going to cover the structural damage, your personal property, and depending on what type of flood policy, it can cover even more. So most people are familiar with the National Flood Insurance Program. That's kind of the government standard of a flood policy. It provides a maximum of 250,000 for dwelling coverage and 100,000 for contents or personal property. It does not include replacement cost. It does not include coverage for additional living expenses if you're not able to live in the home. Other structures aren't going to be covered under that policy. They may need to have separate coverage purchased. Now we have options of private flood insurance. So instead of having to go just with that NFIP or National Flood Program, you can purchase a private flood insurance policy. Our most common company we use is Neptune. Neptune would offer replacement cost on the dwelling and the contents. Gives you the option where most policies exclude personal property in the basement. You can purchase up to 10,000 of coverage for the personal property. You can add on coverage for additional living expenses, for detached structures, for damage or refill to an in-ground pool. Lots of options there. And why it matters is a lot of people we hear very frequently, I'm not in a high flood zone, I'm not worried about it. But 40% of flood claims come from outside those high risk flood zones. And flood affects every state in the US. So we know that there's been shifts in weather and how that has affected different areas. I'm sure a couple of years ago, the mountains of North Carolina didn't think they needed to purchase flood insurance. But it is something that we want everyone to at least consider. So when we're working with clients, we're going to provide a flood quote for every property so that, again, they can have the education and make the decision that's right for them.
So it's not just people that live near rivers. And is the water from the ocean, is that covered as part of this, or it has to be rainwater?
No, it would be, yeah, floodwaters from like a hurricane, high tide, tidal waves coming in would be covered. Even street flooding. So we were talking earlier, John, that I lived in Colorado before moving to New England. Colorado does not see a lot of rain. And so sometimes it will get inundated with a downpour that it can't absorb. And suddenly the streets have literally flooded and it's running into homes. That is all considered something that flood insurance would cover. Again, if it meets those parameters of, 2 or more adjacent properties, 2 or more acres of normally dry land.
Why don't the homeowners insurance carriers just have this as a rider that you can add? Why does it have to be a separate insurance?
Some do, depending on the flood zone. So it's carrier specific, but pure insurance, for example, they can add, they'll have a rider that will add, Cincinnati Insurance has a rider that will add it on there if you're not in a high risk zone. But as Jan had stated, you see most of your flood claims come from non-high risk zones, right? So you can add that to your policy depending on the carrier. And if not, you have these separate policy options where you can go through the NFIP, as she mentioned, or you have these other carriers that are private. You can also buy, if you go through the NFIP, they have standard limits, and some homeowners carriers will give you that option to buy up. So if you have that plain 250,000 with the NFIP, but your home's worth 5 million, you can add that endorsement to cover the difference. So it really depends on the carrier and the flood zone.
And I'm sure the premium differs based on where you live and what your risk is.
It does, yes.
Okay. But it's good for everyone to at least look at this.
Yes.
And analyze whether or not they want to get the insurance.
Exactly.
One question that is somewhat related. I think I know who this came from. What advice do you have for earthquake insurance in New England and earthquake-prone states like Utah and California? For example, is private earthquake insurance better for California clients than the state earthquake insurance?
So I'll answer for out here. Some of our carriers here will actually allow earthquake to be added as an endorsement to the policy. Um, and again, it's what each individual is comfortable with. Most earthquake policy endorsements, additions to your homeowners, are going to have a little bit higher deductible. So it's not going to be something that covers, the small tremors. But if you truly have a big loss that's damaging the foundation, damaging property, you can include it there. For some of the Western states that have the stronger ones, I'm not as familiar with. I know it's a separate policy a lot of times that kind of handled like flood, that instead of doing an endorsement, they want a separate purchase.
Correct. So yeah, in John here in New England, we've had some tremors lately. Actually, we had one recently, not that long ago. I felt when I was sitting at my kitchen island, it was a little terrifying. But you can endorse that simply onto your homeowner's policy. You can ask your agent to price that out. Out in the California market, obviously a little bit different. A lot of those carriers won't, offer that, and you would have to get a separate earthquake policy.
Where does parametric fit into this too? Is that part of the parametric market as well?
James, do you?
I have not seen an earthquake parametric. That doesn't mean it doesn't exist, but I don't think we've seen one, at least in
No.
regular use.
Yeah.
For individual parametric, it's very heavily used in like the reinsurance marketplace. So they from like on a book of business standpoint, that might be something that's used. If there's an earthquake of this size, you get a payout for this that would offset potential payouts for a book of business, for example.
Okay. And how do people know if they're wondering, does my homeowner's insurance have the earthquake insurance as part of it? You just look at the policy document or call your
It would
agent
be an
or
endorsement. It's not automatically included. You would have to endorse it. And
Yeah. So you would look at your policy. I would say the best thing to do is ask your agent. If you don't see it there, it's probably not included. Like James said, it's an endorsement, but you should check in with your agent and see if they added it or if there is an option to add it.
all right, great. Yeah, that's good advice. Last question. What is the difference between a working with like a captive agent, like a State Farm, Amica, versus working with an independent agency like USI that has access to a broad range of carriers that they can get quotes from?
So captive is just like it sounds. They are working with one carrier. So that is the only proposal they can offer is what that carrier does. With us as an independent broker representing multiple different carriers, we can go out to the marketplace and find what's going to be the best option for you, depending on what's most important. Finding the ones that offer the coverages that are most important to you, finding that for the best overall rate. A lot of carriers will max out at 5 million for umbrella. So if we're needing something more than that, then let's make sure that we're going to markets that offer 10 million or 15 million of umbrella. And so really looking at the overall and having that access to numerous ones so that we can find the most competitive option for you, not just in price, but in coverage.
And do you think there's a difference in how claims are paid out? I'm thinking back to a couple of weeks ago when the president was threatening State Farm for not making payments on claims from the Palisades fire.
You know, for us, instead of talking about other carriers, I'll talk about ours. We work with carriers that we know are strong financially, are good service providers, ones that we're going to be comfortable with. Also, by having an agent, if for some reason you run into an issue or there's that one adjuster who is not thrilled with their life right now and not being particularly helpful. That's where you have your agent and team here to help get you through those situations. So knowing who's on your side, knowing that the company is been vetted, been chosen by us as your agent, that it's someone we're comfortable working with. And because we're a national broker, we have a little bit more pull or
Leverage.
within these carriers. Yes. So we want to make sure that we can continue that relationship, as do they.
All right. Do you have anything to add to that, James, from a national perspective?
Look, I think the easiest way to think of it is agent. The word agent is they are an agent of the insurance company. So a captive agent, their loyalty to start with is to the insurance company for which they work and the product they sell. There's nothing against that. Look, I've worked in that space and it's fine. As a broker, you're not beholden to them. I mean, you'll get in trouble if you like pretend clients don't have losses and sneak them into their insurance company, right? Like we have covenants and contracts with them that make us follow ethical rules, but we're not an agent of that insurance company. We're a broker who has access to it. So just philosophically, in my mind, that's the difference. Is it puts us more on the side of the table of the client as opposed to the insurance company. And having been in the captive space myself in my career, I could talk to you about all kinds of issues you have, John, but I only have one solution I'm going to pull out of my bag, no matter what, right? So either I'm not going to be aware of or want to talk about things that my solution in my bag doesn't work for,
Right.
right? So as a broker, I can be much more consultative because I have this open architecture of solutions that I can grab and build the right thing. I have a home insurance policy that I think is the right fit for you, but they don't even have a cyber endorsement. That's okay because I have a standalone cyber piece that I can pull in, and maybe their auto doesn't work, but that's okay. We can grab an auto piece and bring that in. Like we're able to do that. Ideally, we like to keep things in one company because there's advantages of that, but we are not restricted to say, oh, I'm sorry, I'm only, insert one of the farmed named insurance companies. And so if it doesn't fit in that box, I don't have a solution for you. And so that's for me, that's really the difference.
All right, great. Thank you.
I think someone just asked if they were in Florida and in Mass, if Jan was able to provide services. So I just wanted to throw that out there that yes, she is able to do that and
Yes.
happy to.
Yep, exactly. We are, again, a national broker. I personally am licensed in over 20 states. If I'm not licensed, depending on what it is, I can get licensed, or we have others that are. So feel free to reach out regardless of what states you're currently living in, and we can take a look at it.
All right, awesome. I know we went way over time, guys, but our audience stuck with us, and there was a lot of great information that came out of this. So thank you for your time today. And if you have your contact information up there, so if anyone has any further questions, they can reach out to you.
Thank you
Great.
for
Thank you
having
for
us.
having
We
us.
appreciate it. Yeah.
Thank you.
All right. That's it,
Have a great
everyone.
day.
We'll be following up with an email with that attachment that I mentioned and a recording. This is being recorded, so we'll send out the link to the recording.
Great.
Perfect.
Goodbye.
Thank you for having us, John. Bye.
Thank
All right.
you.
Bye.
Bye.